Welcome to Small Business Accelerate, session number 7. We've been walking through the 4 steps to growth. We began with understanding our current market. We then expanded to building a sales strategy. And now we're looking at outreach and operations. Today, we're going to be exploring linking your sales plan with your budget. This is designing a strategy to have a plan to implement a way to grow your business that you can manage your finances effectively. Before we get started, though, let's ask a few questions about what we learned from the homework. The first is, which channel was best for your business? Let's say for the current customers. Which channel was working best to draw in, communicate, and engage? Was it the storefront, referrals, or a sales representative? How can you use sales channels better to improve customer retention and increase sales to these adjacent and new customers? Did you find that the customers that are adjacent or new aggregate in different places, physically or online? Did you find they have different needs as they walk through your website or in your store? This is important because each group may aggregate in different places, and efficiency means I will get to them as a large enough number for the least amount of money. Yep. As you explored these pieces, what surprised you? What did you think was true, but you then began talking to customers, walking them through your website or your actual brick and mortar store, and you learned something new? What was that? Well, look, right now, this links all together, where we want to certainly retain our current customers and grow market share with our adjacent customers and expand to new market segments through an enhanced market value through new customers. In other words, that killer value proposition that will give you more profitability and greater sales. But if we're going to do that, we've got to link this strategy to retain, grow, and expand this marketing and sales strategy with operational management. How do we know that our company operations and its finances will support that strategy? So every startup or small business really naturally either flints into 2 areas. One is technology or product focus, making that just perfect with all the tweaks, or customer and marketing strategy, outreach and sales. It's very challenging for leadership to lean into both areas. We each have our own passions. Now, this is important that you critically manage both. A sound and managed financial plan is required to turn that technology into a product and then produce that product at a scale and deliver it to your customers, either through a store, another sales representative, store, or through online sales and shipment. How do you reach and retain your current customers and then grow your business to adjacent and new markets? You have to manage all this. This is challenging. So there are 6 key metrics that we can measure in your business that are really actually quite simple that help you know where you're at. The first is really the average revenue per customer you're seeing. The second is your customer acquisition cost. Third is your customer churn rate, or the number of customers who leave the sales funnel, revenue generating rate, burn or spending rate, and the operational efficiency. I will warn you, this section involves numbers and math, but not complex math. It requires you to think about where you get your numbers, how accurate the numbers are, that you put into very simple spreadsheets to get very simple answers that illuminate the efficiency of your business. So, start here. What is the average revenue per customer? Some thoughts. How big is the problem you're solving? How many people are willing to pay for that solution? You've spent a great amount of time characterizing this current and adjacent market. You should have very clear answers on this. You should also know whether the solutions are purchased once or are they repeat purchased. Is there an upscale plan or a bundling strategy that allows you to put more things together and resell to your customers? What market segment shows the most willingness to buy your product today? the ability to pay the top price for your product, and the need to repurchase or purchase additional products and services so they stay engaged with you. And finally, maybe an opportunity to support you, refer, and engage with you to get to new customers. Notice that this may not be all the same segment. Who do you want to pick first that is most effective to giving you the highest amount of sales? That's the question. And then we need to work through the worksheet. So in each of these segments, you can write down what the segment 1, 2, and 3 are. What I'm asking you to do is assess their willingness to buy. Okay? How much are they interested? Okay? So if you take the total number of customers that you know in that segment and you divide that by the total number of customers that are there, times the average unit price, this is the potential you have to sell. Now, what do I mean by that? That you may know that there are, let's say, 10,000 people in your town who make over $100,000 a year who could get involved in your actual cleaning service. That's great. But you may find out that of those folks, 40% of them already have cleaning service contracts. So now only 60% of them are really available to be sold to easily. So that's how you would judge the numbers. 100, maybe the full. Again, 60% of them would be the ones that you have available to you. All right, the ability to pay top price. Again, who in each of these segments and numbers do you think would be able to pay top price? This allows you to make another calculation. The number of customers in each box, they'll pay top price, divided by the total number of customers that you think you have, times that elite sales price. Maybe it's a upsold offering that you would like to bundle services together that you make more margin on. Again, which segment is likely to buy into that? The need for additional purchases. Do you find that one of the segments will come back and buy again and again? Or do you find that some segments just buy once? You know, maybe it is that gentlemen who are coming to your stores buy once and kind of just make do. But possibly the ladies or the younger members of your customer base may be interested in repurchases and upscale purchases. So this allows you to define across certain segmenting strategies. And once again, you take the total number of people who will buy at that higher rate, divide them by the total number of purchases that happen in a year, times that price. And that gives you an option to know what is it worth. Then we look at the potential for growth. Again, evaluate each one of the segments. Do you have more space in terms of new customer number? Or do you have more willingness, so you acquire more in a period of time? So in this case, what you're doing is you're multiplying these numbers times numerics of pricing, of sales. This allows you to get financial numbers that you can sum together down here. And then you can now look at which sums are the highest. And obviously that tells you which segment is probably the most adjacent to you and the most profitable for you to reach to. And then you can assign a priority ranking of 1, 2, or 3 to that area. Again, we're looking at the efficiency of sales per customer. Second is customer acquisition cost. Where do your customers aggregate? Physically, electronically, and socially? How effectively can you reach them? What is the process required for you to convert a suspect to a prospect, and then that prospect into a customer? How long does that conversion process take? What is your internal cost to move that process along, to find them and do the conversions? What are the external partnerships and costs do you have to run this process? Why are we talking about this now? Well, it's because we've been discussing sales funnels and sales channels. You now know what you need to do and what partnerships you need. Either people you need to hire, online repping organizations, or partnerships, and they all will cost some amount of money. So the worksheet looks very similar. What outreach strategies do you need to be involved in? And it'll cost you some internally, and it will cost you some externally. So what you want to do in this process is put down what you think those costs are over a period of time. That may be a year or a quarter. Sum those internal and external costs into a total cost number, okay? And if you then can look at the efficiency, what are the number of outreach events that you created? Emails, phone calls, other types of activities that you've done, and you can divide that total cost by the number to understand the efficiency of that process. Next is targeted communication with those suspects. Now we're going to break this down. Just the suspects, new people who don't know you, what are the costs internally and externally? And you can then measure that total cost by the number of suspects engaged over a period of time, such as a quarter. What are the targeted communications to prospects? What are the ways that your sales representing strategy reaches specifically to them? Again, calculate internal and external costs and divide that by the total number of prospects that are involved. So again, total communications, those focused on the suspect side, the prospect side, and then finally, deal creation costs, customer conversion events. What are the number of events happening and the cost for those, and internally and externally? Sum those up, and you can divide those also by the total number of new sales to find that. Now, this allows you to understand of new customer costs, your prospects, and your suspect costs. Then you can add these together and understand what is it really costing you to manage all aspects of your sales funnel internally and externally, and looking at the efficiency. I spend this much on total communication, of which some of it is suspect, some of it's prospect, some of it's customer. Or do I spend a little bit on suspects, a little bit more on prospects, and most of it on customer conversion? The efficiency of each of those steps tells you if you're spending the right amount of money to drive the funnel. You have your estimates. This should validate whether you're putting the right money to those estimates. The next piece, number 3, is customer churn rate. This is looking and tracking customer engagement. Can you track who's purchasing your products or not? They come to your store, they don't make a purchase. They go to your website, but they fall away. Google Analytics and the person managing your storefront should be able to tell you. Track them where they stop and look. Track them which pages they're interested in. Measure the effectiveness of this new acquisition and measure how much they become interested and they disengage. Compare the numbers. Are you engaging more or disengaging more? Next comes to talking to customers yet again. Why did you leave? Send them an email, phone them, talk to them, understand. Learn what would incentivize them to remain active. Is it price? Is it service? Is it ease of use and purchase activities? So what activities can you control to retain your current customers? What are things that you just can't control? Focus on only the things you can change. Okay? Again, rationale for retention. It costs 5 times as much to attract a new customer than to retain one. Customer retention is very, very important. Of the people you retain, you can increase profits by up to 95%, but just minimally 25% by engaging in repurchasing from those different groups. Remember that your current customers are likely to spend 50% more likely to spend more on your products than new customers are, because they're just figuring you out. Retention is key, so we don't want people disengaging. Now, the worksheet is very simple. What are the customers at the beginning of a time period, like the beginning of your quarter? What's that number? And what are some notes to tell you about those customers or the periods and special things? What are the number of customers you have at the end of the time period? Okay? What changed? What's the churn rate? Total number of customers at the beginning and end. Is it positive or negative? Well, we want it to be positive. We want it to be really positive. But we need to be aware of those who are leaving and why. What's the revenue comparison at the beginning of the period and at the end? all right? And this allows you to compare now the revenue churn rate. This is the difference between the beginning and the end, measuring the kinetics of sale at the beginning of a quarter and the end. This could let you know whether maybe you're getting more churn or focusing on more customers that are buying more products. So you may be making more revenue with less customers. But you need to understand how often they return. Are you building the sales funnel such that more and more customers can come down and be involved in purchasing? So the key here is that a negative number in this revenue means you gained revenue, okay? The beginning minus the end. You've gained revenue if that happens. A positive number means you had more revenue in the first bit of the time period than at the end, and that's a problem. So what you want to do is understand, am I gaining customers? Am I gaining sales? And how do those two things relate together? That comes from talking with customers. All right, now we're again optimizing sales. We're looking at these key numbers. Revenue growth rate, this is key. Cash flow is the cheapest and best form of company funding. To do that, you have to achieve revenue growth. And positive cash flow is possible when you allow the company to grow revenue and then thus sustain itself and reinvest money into its own sales funnel rather than taking out loans or getting equity investments. It's also a key metric for measuring the success of your outreach, product service and delivery processes, and other support functions in your company. Are you driving revenue? So effectiveness of your team and your product and the openness of the market are all looked at with this one number. Again, revenue in the past time period. Define the period. What's the revenue value and what's the growth rate you saw beforehand? Again, that change of revenue at the beginning versus revenue at the end of the time period. Again, you're looking now at the revenue in the present period versus the past period. And you can calculate a growth rate by saying, what's the difference? Did it go up by 1%, 10%, 100%? Okay? It's a very simple set of math. We take the revenue of the past period minus the revenue of the current period divided by the revenue in that past period and multiply times 100. That tells you what difference has occurred in that period. If you want to look in more detail, look at the market segments. Which points are the revenue happening? Maybe you want to look at in-store revenue versus online revenue. If you may want to look at sales representative revenue versus referral revenue. If you can link those pieces together, that helps you. If you can look at current customers versus new customers, that allows you to understand segment performance. So you can look at revenue growth across your entire company. You can look at revenue growth based on sales channels, such as my storefront in actually physical versus web, or I can look at new customers versus old customers. Many different ways to see what is working and what is not. Am I efficiently keeping my current customers? Are they coming back to me? Am I finding new customers? Is my online working better than my in-person? Does it justify the investments I have? The fifth model is burn or spending rate. This is the ratio of revenue to your spending rate. This determines the length of time that the cash you have available for your company to survive. You can control the spending rates. You can spend less so you have more revenue available to keep your company going. This revenue to burn rate ratio informs also people who may want to invest in you or loan money about the risk you offer to them. Banks, investors, for example. You estimate the cost of sourcing all the physical inputs to build your product and service. That involves your raw materials, your physical place, and the humans who make the product. Express that number as the percentage of your sales amount. In other words, the revenue amount. With increasing return of these sales, your cost of doing goods will decrease often with the volume of your sales. So in other words, as I make more, my cost of goods will go down because my CapEx is fixed. My input costs are fixed, and that allows me to get volume discount and make more money. Many products look like this. However, some decrease the return with scale, meaning the cost of of doing business, the cost of goods sold, increases with volume due to maybe capacity constraints or just the fact that we've not automated efficiently. And it takes a lot of hands-on time, and humans are expensive. So this allows you to know how your volume is affecting your revenue and your scaling. Then we also want to look at estimating the direct cost from your suppliers, your collaborators, your experts, others you're working, and infer to see whether those costs look similar for what your competitors are doing. Are they able to scale better because of facilities, of training, of retention of employees than you? Or do they have a similar cost structure? This is a way for you to understand and estimate cost of goods sold and compare them with what's going on in the market. Expenses include a number of things, such as your facility cost, your labor cost, and other costs, including marketing, sales, legal, administrative overhead, others. It includes taxes, various types of taxes to be paid, tax credits, it takes those into consideration, interest on loans, and maybe the internal rate of return you've promised to equity holders, including yourself. In other words, you want the value of your business to increase every quarter, not decrease. It becomes a very simple worksheet. You take all of your attributes, the cost you have, and you put them in here over a time period. You sum all your revenues in a period in the same area. Now, the calculation is pretty simple. Total revenue minus your cost equals your burn rate over a period. And when you measure it over a quarter, you can notice whether your burn rate is increasing or whether it's staying the same or whether it's decreasing. So measuring this from previous 2 to 3 quarters and then following it over the next quarter allows you to see trends. Am I spending am I not spending enough? Do I think that I'm coming into a riskier time where savings is more important? Or is this the time to capitalize and grab as much market as possible? This number gives you that information, and you can then connect that with how long you need to run your company at the current rate. You can also look at this from your profit and loss statement. This is an example of one you see over here. For the net burn rate, you look at the net income value basically at the bottom of the sheet. This takes into consideration total income and the total expenses that you have here, as well as net ordinary income and other forms of expenses. For the gross burn rate, you take your total expenses, which is in the red down there, you subtract, you basically take that number and you look at the total income at the beginning and you look at the difference and you find out that is my gross burn rate. And sometimes I spend more than I'm making. Where does that extra money come from? It comes from your bank account generally, or your own pocket as the owner. So you want to make sure that the expense number in red is less than the total income when possible. And then look at the other types of expenses. Talk to your accountant. Different ways expenses may not be represented in your normal P&L statement. Making sure you understand every dollar where it's coming in and how it's going out. This allows you to manage your business on a monthly basis, quarterly basis, seeing the trends. Now, getting the most out of your investment into the business, all your time and your money, looks at operational efficiency. How much value are you getting from all the activities? Maybe you have research going on for new types of products. Maybe you're developing the next generation of products. Maybe you have a cost of goods for your product that's being looked at. Marketing, sales, general and administrative costs. All of these are places money goes. They involve people or collaborations where you're spending your money. Looking at these efficiencies tells you about where you're putting your money and what the option is. We want you to put your money on the most valued, highest return activities. That could be today or it could be in the future as you know that you have a new product that could really be the winner. What you really want to do in this spreadsheet is you start with your total revenue value, okay? This allows you to take a ratio of that total revenue divided by the cost. I apologize. I'll start over this. Now, with this spreadsheet, What we want to do is take the total revenue that you have over a given time, a month, a quarter. Take that number and you want to divide it into the cost of each activity you have and multiply it times 100. So for research and development, you look at the salaries and the materials and the testing that's going on. Take that number, divide it by total revenue, and we'd like to get a number around 15%. Generally in non-R&D intensive businesses, to say that we're always looking to the future, but we're not overspending on the future in light of getting more revenue today. Likewise, overhead. This is general and administrative cost of your business physically and your positions. We want those costs divided by your revenue to be around 10%. We don't want to be running a huge cost of exorbitant types of perks, buildings, offices, or services. We want to make sure we're running lean. We want to put most of our money from most small business into marketing and sales, okay? This is really critical. That number should be looking around 40% of our revenue needs to be driven there. We want to be investing in what will bring in more revenue than next period of time we're measuring it. Now, cost of goods sold will be a lot of the different costs to make the product or service you need, okay? That's really important. And then finally is what we call net revenue. That's profit. That's when you take all your costs and your total costs that you have and you divide it by all those, the total revenue you have, and you find, I want at least 15% left over. I need to be making some money every period of time I'm looking. These ratios help guide you. Now, of course, they're not fixed. They can change if you want to be focusing more on new products, you want to be growing your team or training or moving into a new facility, that number will change. Marketing and sales may change based on whether I'm leaning into current customers or really reaching out deeply into new customers. How is this working? Building new cost of goods sold will always be higher when we're introducing a new product because you're establishing new supply chain lines and raw material sources. So the numbers and the ratios will change, but this gives you a place to look at where am I sitting. So with these 6 tools, you can optimize your pricing and your revenue ratio. This allows you to understand what my revenue projection is and my cost projections. I will not be surprised or shocked. I can then establish the sources of my money, the revenue, and how I use the money for running my business or how I could get new money and invest to raise more capital and generate more sales from raising that capital. This helps me also understand what my valuation is because I understand my costs and my revenue, it's growing, and how that multiple on sales can be measured. And then this allows me finally to build to say, what is my ownership? What is your ownership if I take extra funding into my company? Always with your product price estimation, be customer centric. It's the value proposition and confirm the willingness to pay at a specific price. This is related to differentiation. You need to offer something better, differentiated, and improved compared to the competition. And take into consideration value chain constraints. That in other words, you may have someone needs to buy other products to go with yours to realize the full value. That means you may not be able to get the full profit unless you can deliver a full solution. So be aware that partial solutions come at a discount. So a few things to consider when you're working with these numbers. First, all your financial projections, no matter how hard you work, will always be wrong. Just get over it. But having them is actually really important because it allows you to make some plans. You'll also note that your projections are always out of date. You're always looking backwards and you're having guesstimations forwards. These guesstimations or projections are always optimistic because we think things are going to happen and we always experience more problems than we expected. Financial projections are not a substitute for operational accounting and record keeping. So all of these strategies allow you to look at your business and project to the future based on what's happened in the past. But having a good accountant and keeping good records as a business owner is absolutely essential. So know your finances, budget wisely, be disciplined in how you use your funds. Know how your cash is flowing in and out. Be detailed. Be customer focused with your service and your pricing. And yes, you must sweat the details. So for your homework, linking your sales plan to a budget. Basically, we need you to complete these 6 worksheets: the average revenue per customer, customer acquisition costs, customer churn rate, revenue growth rate, burn or spending rate, and operational efficiency estimations. Work on all those. This allows you to come into this final worksheet, which is the one that estimates how you are basically allocating your monies against your revenue, and what are those ratios. Are you spending money which is going to yield you the most value today and tomorrow? We can't invest everything for today. We need research and new development. We need to take care of our people. We need to produce and make our sales product, but we also need to sell, sell, sell. So knowing those ratios and working through these particular worksheets will give you great insight into how your business is doing during any period of time. So there we have it. We have now finished our 3rd step to growth, outreach and operations. We move from building out these sales channels, and now we're linking the efficiencies of our sales funnel and channels, into linking this to a sales plan and our budget. We know how we're spending our money and how effectively we're spending our money. Look forward to getting back together as we then now design a growth plan, which will be our goals in our plan, our roadmap forward, and how we pitch this for partnerships. So until then, this is Small Business Accelerate.